Hello, ladies and gentlemen, and welcome to this podcast on the basics of financial accounting. I am your host today, and my name is Jean-Pierre Bruwer. I am better known as JP Bruwer, and I am a silent facilitator in the Entrepreneurial Skills Development Program. What I want to talk about today is the very basics of financial accounting based on module number 6. In your workbooks, you will have seen that there is a term called accounting. Now, when we hear the word accounting, this has various meanings. Accounting can mean money, it can mean keeping records, it can mean evidence-based information which we are keeping. But for our purposes, accounting has to do with 4 key words, namely users, financial statements, information, and decisions. I'm using abbreviations because I dislike writing on the board, so just bear with me, please. If we go to the very first word, which is called users, who am I referring to? Well, these are the people that will make use of our financial statements. Now, I'm sure that you can think of a couple of users. What about the South African Revenue Service? They are always interested to know what profits we make and so on. There's also possible investors who are interested in knowing how our business performed. Main reason is if they can get a return on investment, they will be more likely to invest in our business. Other people or users that may be interested is that of creditors. Now, a creditor is someone we owe money to. Creditors would like to know whether we can pay them back in the nearby future once they have given us certain things on credit. More users that we can think of, this can include customers. This can include banks. And even the owners. The owners of a business also wants to know how the business is doing. These are the users of financial statements. Take note, these are only some of the users. There are many more which we can think of, but for our purposes, we are just going to keep it as such with users. Hence, if we go back to the first section, users we have discussed. Next up is financial statements. Now, if we go on to, let me just make a new slide. If we go on to financial statements, that should be a T. Financial statements we make use of in order to tell us how our business is doing financially. Now, specifically, we can make use of many financial statements, and in this specific module, we only make reference to 3 financial statements, namely the income statement. We also have the balance sheet. And we have the statement of changes in equity. Now, just for clarity, the income statement we use to tell us how much profit we make in terms of net profit and gross profit. The net profit is all the income minus all the expenses. The higher the net profit, the better for our business. When we look at the balance sheet tells us how big our business's assets are compared to its equity, compared to its liabilities. Now, I know we haven't really spoken about anything in relation to assets, equity, and liabilities, but we will get there very soon. So that is the balance sheet. The statement of changes in equity tells us how much equity has changed in the business. Again, I have not touched base on assets, equity, or liabilities. Hence, I'm not going to go into too much depth now explaining exactly how we are going to go about with these financial statements. I'm just touching the bare basics. So we can tick off financial statements as well. The next piece of information we need to take into account is information. What type of information do we get from the financial statements of a business? Well, there is something called profitability. There's something called liquidity. There's something called solvency. And there is something called efficiency. When we talk about profitability, it is the ability of a business to make profit. You can see that the better the profitability is, the broader the smile of users will be. When we look at liquidity, liquidity comes from the word liquid. And liquid in accounting has to do with the cash on hand situation in a business. So liquidity means cash on hand situation. Solvency in turn relates to assets versus liabilities. Now, just in summary, we have not even discussed assets and liabilities yet, but the more assets you have, the better for your business. The less liabilities you have for your business, the better. So what we want to do, if we can just use mathematical terms, assets should always be bigger than liabilities. How do we know it's bigger? Well, this is a trick that I've learned. That is big. Lastly, we have efficiency. Efficiency tells us how long it takes for a business to make money. I'm trying to draw a watch. Yeah, let's just pretend that that is a watch. Efficiency is how quickly a business can make money. The quicker a business can make money, the better for users. So what we have now discussed is, information. The last section which we have to cover from the definition of accounting is that of decisions. Now, when we make decisions from a business perspective, what specifically do we have to decide on? Well, it depends on what we want to do with the business. Maybe it relates to expansion. Maybe it relates to employing more people. Maybe it relates to products. Maybe it relates to services. And we can mention many more things. As service quality, product quality, all of those aspects, among others, will be influenced when decisions are made. Now, just to make clear sense as to how all of this fits in with the definition of accounting, we have users of financial statements who need information in order to make decisions. So we can summarize to say that once we have relevant information, decisions can be made using the information provided in the financial statements, which are these financial statements that will allow these users to make the actual decisions. So from my side, I have covered the definition of accounting in depth. Next up, what I want to do is to discuss the basic elements of accounting. In accounting, we have three basic elements, namely assets, equity, and liabilities. Now, some of these terms you may have heard me use throughout this entire podcast, so I'm going to clarify them accordingly. If we can focus on assets now, the actual definition of an asset, and I'm going to give it to you straight up, do not even attempt to take this down. An asset is a resource that you control because of a past event which will result in a future inflow of economic benefits that has a cost or a value and a probability of cash flowing into the enterprise. Now, that is a formal definition which accountants use. Okay? In order for us to clarify assets, we are going to make use of keywords. Resource, control, past event, and future inflow. When we focus on liabilities, a liability's formal definition is known as follows. And again, do not attempt to write this down. A liability is a present obligation because of a past event which will result in a future outflow of economic benefits that has a cost or a value and a probability of cash flowing out of the enterprise. The key terms which we will have to make reference to is present obligation because of a past event that will result in a future outflow of economic benefits. In terms of equity, equity is just assets minus liabilities. Or we can say that equity consists of four components. CIDE, which stands for capital, income, drawings, and expenses. This is now just a big overview as to what I'm going to discuss. Let us take all of this information and take it step by step. An asset. The definition of an asset we know relates to it's a resource that we control because of a past event which will result in a future inflow of economic benefits. Let us assume that for this example we have something like this. As you can see, my drawings are fantastic. Let me just give more character to my drawings. Right, this is a Hummer. Yes, a motor vehicle, Hummer. So I hope you can see that. If we look at the key terms used, a resource is something that is scarce and something that can benefit us in the nearby future. So if we look at this Hummer is a resource of what? Maybe of transportation, to transport people from one point to the next. Maybe to deliver goods from one point to the next. So this is definitely a resource of transportation. Next is control. How do we control the vehicle? Now please don't try to be creative and say with the steering wheel. That is not the correct answer. You control the asset by means of paperwork. Now, when you bought this specific Hummer, you had to undersign a contract whereby you say, listen, I will hand over the money accordingly and then you give me the car in return. After this signature has been made, it means you are now in control of that vehicle. You own it. Control vests in ownership. And by the way, that is not my signature, just in case you want to copy and paste it. Past event, it's self-explanatory. It is an event that happened in the past. Let's say we are busy with today, and there's a yesterday, and there is a tomorrow. Let's assume that we bought this specific Hummer yesterday. When we look at the books of the business today, do you agree that since it happened yesterday, it is a past event? Hence, this Hummer will legitimately be regarded as an asset based on this past event matter that I just explained. Future inflow. How on earth can this Hummer result in a future inflow? Well, this Hummer can be used to transport people, transport goods from one point to the next, or the Hummer can actually be sold in order to make an income. So this is what is meant by future inflow. Let us just tick off all the boxes. This Hummer is a resource because we can use it for transportation purposes or delivery purposes or even sell the vehicle if we want to. Control, it vests in ownership. Past event, yes, taking into account what we have discussed over here, yesterday and today. And then we have a future inflow. This Hummer will result in money coming into the business. And that is what an asset is all about. So now you can impress people at home and you can say, listen, I know what an asset is. An asset is a resource that you control because of a past event which will result in a future inflow of economic benefits. Next up, let's do liabilities. We know that from liabilities that there are a few key terms which we will have to remember. It is a present obligation because of a past event which will result in a future outflow of economic benefits or future outflow of money, depending how you want to say it. If we can use the example of someone that we owe money to, this is a loan shark, as you can see by the fin on the head. With this said, we have to take into account the criteria of a liability or the definition of a liability. In terms of present obligation, we have to break down this specific term because it consists of two words. Present means now. Obligation means responsibility or something that has to be done. Hence, a present obligation is a responsibility that has to be done now. If this loan shark is a present obligation for us, it means we have to pay back this loan shark immediately. Just imagine this loan shark gave us a loan, please note it's US dollars, of 5 million. When would you like to pay back this money? Well, as soon as, because there's something called interest which we will have to pay on this loan. And loan sharks, well, they charge excessive amounts of interest. So present obligation, the sooner we pay back this money, the better. Past event. Let us assume that this specific loan was obtained during the course of yesterday. Today, oops, that should have been a straight line. Today, we can see that this transaction took place yesterday, meaning that it was a past event which took place. Future outflow. This relates to the fact that this amount of money will have to flow out of our pockets in order to repay the debt to this loan shark. One thing that I want to make mention of, and this is just to distinguish or to differentiate between assets and liabilities. You will see that there's a future inflow for assets and that there's a future outflow for assets. To make things a bit more interesting and more understandable, just imagine you have a wallet. This is a wallet. An asset will make this wallet become thicker or bigger. It's almost like make the circle bigger, it's just make the wallet bigger. So a future inflow, in terms of assets, this is what it will do to our wallets. When we go to a liability, on the other hand, this liability will result in a future outflow, meaning that our wallet will be extremely thin. We will have to pay back money in the nearby future. So that is the difference between assets and liabilities. Again, you can now also go back home and say, yes, I know what the definition of a liability is. It is a present obligation because of a past event which will result in a future outflow of economic benefits. Lastly, I want to do equity. Now for equity, it is a very interesting element to explain. We have now discussed what assets and liabilities are. In short, equity is the same as assets minus liabilities. So, how do you explain equity? You can really be fancy and you can say, oh, of course, it is all the resources which we control because of past events which will result in future inflows, minus present obligations because of past events that will allow future outflow of economic benefits to take place. But you can see this is quite a long explanation. So, I've got some good news in the sense that equity can be explained in another way. Equity consists of 4 components, namely C, I, D, E. You can decide if you want to make use of this acronym, but the C stands for capital, the I stands for income, D stands for drawings, and the E stands for expenses. Capital is the money or the assets which the owner gives towards the business for starting up. Drawings, on the other hand, is the complete opposite of capital. It is money or assets which the owner takes for personal use. When we look at income and expenses, all that this is, it is the benefits which we, for income, receive because we operate in the business, while expenses is the economic benefits which we have to pay for in order to operate the business. Examples of income. can be services rendered, can be sales, can be rent income, can be interest income, etc. For expenses, there's a huge amount of expenses which we can include, namely electricity, that's an L by the way. We have water or amanzi. We also have rent expense. There may be telephone expense. There may be taxation, etc. There are many expenses which we can list. I didn't even write salaries and wages. So with this in mind, equity consists of CIDE, which is capital income, drawings and expenses. And we can also say that equity is assets minus liabilities. Now, you can also go back home and share that you understand what equity is about. It is assets minus liabilities, or it is CIDE. This specific equation, this is a very important equation. Although it's difficult to express in words, if we express this with E equals A minus L, it is an equation. Just to show you with basic maths how we can develop this equation into a very, very powerful accounting equation, which we will use at a later stage. Using this as basis, we can see that there's a minus in this equation. I am a positive person by nature, so I like to make all my things positive. So what I'm going to do, I'm going to take assets over the equal sign and equity across the equal sign over there. This will mean that we have minus assets is equal to minus equity minus liabilities. And as I've mentioned, I am a positive person. So in order to get rid of these negatives, we're going to multiply by -1 or divide by -1 right across the bench. Hence, assets is equal to equity plus liabilities. This is the accounting equation which we will have to make use of for all accounting exercises, wherever we are, be it in class, be it with case studies, be it professionally. Just keep this in mind, because we are going to make use of this very soon. Furthermore, in accounting, there exists something called a T account. Now, why is it called a T account? Well, it looks like a capital letter T. That's the easiest way to explain this. Over the years, accountants have developed certain terms, which is known as jargon. It's just subject-specific matters or the way in which you express yourself within the specific discipline in order to distinguish between this side and that side. Now, if we look at this side is on the left-hand side, while that side is on the right-hand side. But if you speak of this side and that side, with other accountants, you will drive them crazy. They have something called OCD. They want everything to be precise. So we do not make use of this and that. We also don't make use of left and right. In accounting, we use certain terms. The left-hand side is known as the debit side, while the right-hand side is known as the credit side. It is also abbreviated as DR and CR. Even though there's no R in debit, no one can actually tell me why there's an R in debit. But anyway, fact of the matter is, on the left-hand side, it is the debit side. On the right-hand side, it is the credit side. Easiest way to remember is credit is on the right-hand side. All right. Or if you have a valid driver's license, remember, please stay on the debit side of the road. Let us move on to where we left off last time with assets is equal to equity plus liabilities. Assets, equity, and liabilities have certain ways of reacting towards debits and credits. Assets always become more on the debit side and always become less on the credit side. Equity and liabilities, on the other hand, they like to copy one another. They become less on the debit side and more on the credit side. Now, let us talk about examples of assets. Underneath assets, you can get something called non-current assets and current assets. Non-current assets are assets which you will use for longer than or equal to 12 months, while current assets are those assets which will be used for less than 12 months. Examples of non-current assets include machinery, equipment, land, buildings, furniture. Current assets, on the other hand, this can include inventory, bank, and debtors. Just for clarity, a debtor is someone that owes money to you. When we look at liabilities, we can have non-current liabilities and current liabilities. Similarly to the non-current assets, non-current liabilities will be used for longer than or equal to 12 months, while current liabilities will be in the business for less than 12 months. Non-current liabilities include mortgage loans or long-term loans. A current liability will include bank overdrafts or creditors. Lastly, in terms of equity, we know that equity consists of CIDE. All capital and all income will have a positive influence on equity. Drawings and expenses will be on the debit side. All drawings and all expenses will have a negative influence on equity. Examples of expenses, as I have mentioned before, this can be rent expense, telephone expense, water, electricity, and so on. And with income, we can have services rendered, we can have sales, we can have interest income, we can have rent income, and so on. These are all examples of assets, equity, and liabilities. Ladies and gentlemen, this is the ending off of my podcast. If you have any questions in relation to this specific podcast, you are more than welcome to pop me an email at my email address. Let me just write here, finish writing. Oops, ac.za. It is bruwerjp@cput.ac.za. All in one, no spaces. Thank you so much for watching, and all of the best with your further studies with the Entrepreneurial Skills Development Program.